Speaking of global uncertainties in the last 2 years, I think we have had more than our share. So, how are we positioned now?
I think India is a lot more resilient. The pitch is moving from being valuation-led and momentum and liquidity-led to earnings-led. Outflows from foreign investors that we've seen has all been absorbed by markets here from retail investors. Global shocks do tend to impact the economy, but I think it does not derail the domestic compounding story. India is looked at as a growth market.
Hello, everyone. Welcome to this session. Today, we have an interesting discussion titled Is India Truly Decoupling from Global Uncertainties? And we have with us Ashish Jagnani, who's a senior fund manager with us in the HDFC PMS and AIF team. And hi, Ashish, welcome to the session.
Hi, Ram. Hi. Nice to be here.
So we have titled this very interestingly. So, speaking of global uncertainties in the last 2 years, I think we have had more than our share. Starting from the tariffs, the trade tariffs, we've had AI-led fears. Recently, the war happened. Prior to that, also, there was a series of wars and other things happening. So, how are we positioned now? From Indian economy, if you see the macros, has been reasonably well. I mean, we've not been shaken that much, but still the fears are still there. Thankfully, it looks like the war is over, but how are we positioned from here onwards?
So it has been, a difficult macro. Clearly, we've seen, as you rightly said, a lot of events, some out of our control, some being a part of the markets. And the question here that everyone is looking at is India truly decoupled, from the global uncertainties? So I would say, it's not completely immune from global uncertainties, given the fact that oil price, global rates, FPI flows, currency volatility, these still matter, right? Having said that, I think India is a lot more resilient from the earlier cycles. And that's, I think, is something which we think is very important. There is a lot many factors that India is now seeing, which is driving domestic growth. So clearly, global shocks do tend to impact the economy, but I think it does not derail the domestic compounding story. So if I was to say it in this manner, that we are not completely immune from, the global uncertainties, but definitely we are a lot better buffered than the previous cycles. And I think that's pretty well known, and markets are now beginning to realize that.
Sure. Thanks for that. And speaking of macros, see, we've always had this comfort when it comes to investing in equities that, okay, we have strong macros. We kind of have had got this tag that we are among the fastest growing countries in the world. I think we are the fastest among countries of reasonable size, right? And also this connection that if GDP grows, earnings will grow. If earnings grows, then stock prices should follow, and thereby the case for equity investing, right? However, in the last 2 years also, we've seen some slowdown in earnings, especially in the large caps. Last 3 quarters, correct me if I'm wrong, mid caps have done well. To some extent, small caps have also shown reasonable earnings growth, but the large cap earnings have not come. So if you can detail in terms of what went wrong, or maybe what is the future outlook from now?
Sure. No, so, clearly you're right in, pointing out that over the last close to now 2 years, we haven't really moved from a market standpoint. And, rightly so. Now, if you just step back and look at it, it has been partly a function of the fact that, earnings growth for markets have actually seen a down cycle over, say, FY24. So if we really look at the growth in FY24 was somewhere in the 20s from an earnings growth standpoint. Post that, 25, 26 have been real downgrades now, which is a function of those, global macro uncertainties that we all talk about. Having said that, I think what is important to see and what we are seeing from the last few quarters is this cycle was in in recovery mode. So we saw that in the third quarter. We would have seen that much stronger in the fourth quarter had it not been for the US-Iran war that happened in March. But even despite that, I think the fourth quarter numbers were pretty impressive. So the way I would see it is that it's not been a straight line of earnings recovery, but importantly so, we are seeing broad-based recovery across sectors, across market caps. Now, to your point, and which is what this also underscores that which is why you saw a much wider and a stronger recovery in mid caps and small caps from an earnings standpoint versus the large caps. As large caps to some extent are dominated by financials and tech, which had their own set of challenges, that was not reflected in the large caps. But the broader recovery was covered in the mid and small caps, and which is the breadth. Some numbers, if I was to throw, out of about 28, 29 sectors, you started to see about at least close to 18, 20 sectors which are showing that trajectory, maybe small, maybe big, but that trajectory is beginning to happen. And I think that's the comfort which is getting played out in the mid and small caps, and that's what you are getting reflected on.
Sure. Can you name a few sectors, like you mentioned one or two on the large caps, but overall, where do you see the earnings recovery beginning from?
So what we've seen is that the last quarter that we had, earnings recovery was driven by autos. It was driven by industrials, healthcare, a host of smaller sectors like auto components. You had, some parts of real estate doing that, and few, discretionary consumption-led sectors, which we think are really showing a lot of traction in terms of green shoots of recovery.
What's your take on IT as such? Because given the AI fears, we lag behind on AI.
So I think there is lots that is there in public domain, and there's a lot of confusion. Clearly, what we understand is definitely, India from a developmental standpoint for AI tools has been behind the curve. That said, I think we would see Indian tech being more collaborative with AI tool manufacturers, and we've seen enough instances over the last 6-8 months whereby a lot of the developers of AI tools are collaborating with Indian tech services in order to deploy that. Having said that, I think I have a slightly differentiated view that while one is about development of AI and the second is collaborative, but I think we are pretty early adopters of AI. So there are enough platform businesses like food tech, quick commerce, which are very active adopters of AI, and I think that is what we are seeing in a very big way in our markets. That said, I think we are always terming tech towards IT services, and which is what the current market is, where the current apprehensions are that the growth is going to be lower as a result of efficiency and as a result of AI adoption. But I think it's a journey. We've seen that in the previous cycles of cloud transformation, all of that cycles keep coming in tech. So at this point in time, our sense is that there is a lot of concerns, but if you look at it from a slightly longer term perspective, we think skill sets will evolve, and we would see tech coming back is what we think.
So how are you playing it in your portfolios, like underweight?
So we started off being underweight, but we think now margin of safeties are building while there are still concerns on growth. But I would say that we are now towards more of equal weight in this current underperformance that we've seen across. And I think that's a fair way to position, given as we see more clarity evolve, we see more comfort in terms of growth visibility improving, deal wins improving for tech companies over the next 6-9 months. We would kind of keep evaluating as we move forward.
Right. And let's take this discussion to a bit of valuations, because Indian markets have, at least in the recent 5-10 years, have been fetching a premium. I mean, we've seen our indices, at least the larger indices, trading at a premium that many countries have not seen. We recently we mentioned that India is also the fastest growing country, so maybe some premium was attached. We've seen the FIIs exit in a big way, so a lot of that premium has been removed. So does that make you excited when it comes to stock picking? Like, have you in fact the recent correction, have you made use of that correction to pick up some stocks in the recent past?
No, so I think, clearly a part of the premium has got corrected as a result of earnings growth also coming off. And as you rightly said, that there had been some premium as a function of, FI selling off has kind of brought the premium down. But if I was to see it on a slightly broader note, at levels of 22, 20 times, 23 times, FY 28, P multiples were expensive. We weren't getting, that comfort of margin of safety. But out here at these levels of 19 times growth coming back, valuations seem reasonable. That said, I think the important point to make is that markets are, actually the pitch is moving from being valuation-led and momentum and liquidity-led to earnings-led. So I think markets will strongly follow earnings recovery. And that's precisely what, despite the current volatility that we saw, as a function of oil, given the fact that, fourth quarter numbers were reasonably good, I think markets are very closely following earnings growth. So I think that the entire narrative of just purely valuations and liquidity is shifting towards earnings-led returns. And I think that's where the market will focus on. And some part of it is what we are seeing it in the mid and small caps, where the growth is far higher than the larger caps.
Any other specific pockets where you see relative attractive valuations?
So definitely, the consumer space, be it consumer discretionary, premium consumption, some parts there are clearly, good margin of safety opportunities. Having said that, I think the markets are still waiting for confirmation of, stronger growth trajectory on a consistent basis. One-off is fine. And as you know, there is also narrative at this point in time of monsoon having to impact rural. So I think markets are taking it step by step, but clearly there are pockets where we think there is, opportunities to be made. From a portfolio standpoint, there are some also, select, you could say materials businesses where we think that, the cycles have bottomed out, prices have bottomed out. There are good companies, very strong balance sheets. There is enough, visibility of cycles, or rather prices for these material businesses like chemicals and all of that starting to stabilize. So I think those could be good opportunities to look at from a slightly longer term perspective.
Sure. Ashish, what, according to you, is the basic building block when it comes to wealth creation from equities? I'm just asking you to describe our overall philosophy when it comes to HDFC PMS portfolios. What are the 1, 2, 3 things that we will definitely follow when it comes to stock selection, portfolio construction across all portfolios? And what are the you can explain with respect to our strategies that we manage.
Sure.
From a long-term perspective.
Sure. No, that's good. So basically, our philosophy is simple. And as HDFC, the focus has been to look at quality businesses where we think growth is primary. Management capability is a very important faction. A most important underlying thread of our philosophy is earnings growth surprise. And lastly, is about valuation discipline. So when we see all of this kind of come together, that's where we look at, ideas within our portfolio. Very clearly, our focus is that a quality-led, high growth portfolio is able to withstand volatility that we've seen. And that is, in our view, as market continues to discover it, that's where long-term wealth creation happens. So if I was to kind of give you an outline, there are two strategies that we run. One is all cap. This is a high quality, flexi cap position product where it is giving us the flexibility to invest across market caps. It is focused towards a lot more domestic consumption oriented portfolio businesses. And that gives us, to some extent, it insulates us from, the global volatility. Again, it is more of a compounding kind of a portfolio strategy. That's for all cap. India Ascent is a slightly more, portfolio which is positioned on the small and mid cap. A slight aggressive positioning. It focuses on niche ideas, new growth businesses, which we think will turn larger over the next few years. Today, they are small businesses. These could be in spaces like energy storage. It could be, proxies to data centers or energy value chain, and evolving some of these export businesses, which have been impacted as a function of trade tariffs. So it's slightly more contrarian with slightly aggressive bent. That's where the India Ascent is positioned. So these are both portfolios, but as I said, the underlying thread is focusing primarily on growth, best of management capability, valuation discipline.
Sure. I mean, balancing growth, quality, and valuation has always been it's a challenge in any market, and given the nature of Indian markets, it's all the more challenging. So, how do you balance it? I mean, you can give us an example in terms of, say, maybe how much premium you are willing to pay, given the quality businesses that you want to bring into your portfolio. What kind of average PE from a portfolio perspective do you target?
So, given we are growth oriented from a portfolio standpoint, I'll just give you broad metrics, right? So, the all cap, which is kind of slightly more flexi cap kind of positioning, there are 2-year, growth numbers at a portfolio level. Earnings growth is about 17%, right? With an ROE of 18-19%. Where we look at it from a PEG standpoint, the PEG is about 1.4, right? Similarly, the India Ascent portfolio, which is a slightly, which is focused on small and mid cap, a lot higher growth, slightly more aggressive. There are 2-year earnings growth forecast is about, as per Bloomberg estimate, is about 21%, right? And again, ROEs, these are businesses which are incubating, are turning around, or can kind of take a little longer. So their ROEs are about 17%. But on a PEG basis, if I see, that's about 1.2. So we think that, growth at reasonable price is where both these portfolios are focused with the respective risk profile. The point that I'm trying to make is, we don't basically just build the portfolio purely on conviction. We are also risk managers by conviction, right? What I'm trying to say is that, as you rightly said, it's a very delicate balance of how much premium you want to pay and how do you kind of course correct your portfolio if it rallies. And given that we've seen sharp reactions in markets, the way we look at it is that, at any point in time, when we look at, the portfolio, we continue to keep evaluating. If fundamentals run ahead of, our thesis, we tend to trim it. Where we think that typically markets are irrationally, correcting the stock and the thesis is pretty much intact, we tend to add. And it's very important that we also look at if, some of the stock ideas within the portfolio have probably seen a thesis correction, right? Or maybe it not played out the way we thought. We are happy to kind of trim or exit out of the portfolio. So that's the kind of discipline we try and follow within the portfolio, and hopefully it's held us in good stead.
What's the number of stocks in each of these portfolios? What is the ideal number that you target?
Sure. So across both these portfolios, our average holdings are between 25 to 30. We would broadly range between 26 to 27 now, even as in when we kind of keep building.
Do we have kind of more or less equal weighting, or you will grade it down as per the conviction?
So, by the nature, given, all cap is a lot more flexi cap bias. So there we have exposure to about 60 odd percent is large caps, and mid and small is about close to 40%. As I said, India Ascent is slightly more aggressively positioned. So there we have close to about 75% is mid and small cap and 25% is large cap. So the stock weightages, as per, is slightly higher on the flexi cap given the larger cap weighting. But if I was to look at internally, what we put controls is that just from a risk management perspective, we don't exceed 40% in any sector, and about 9 to 10% from a stock standpoint. In the case of small and mid cap portfolio, which is India Ascent, given that's a slightly volatile space, we tend to manage between minimum of 2% to about 6.5, 7%.
Sure. You talked about the risk management. I think I'm sure that's an important part of the overall process. How do you manage the downside? I mean, from you did explain in terms of your stock positions, etc. But what is the key philosophy behind risk management?
Sure. So as I said, I think the important aspect is that we aren't really wary of stock underperformance, if I was to say. But if clearly there is a impact to the investment thesis, we kind of take it very seriously and probably even have to exit out of it. So the whole way the portfolio is positioned, as I said, is that it's on a constant treadmill that we keep kind of seeing the portfolio. And from a conviction standpoint, it's not only, as I said, that you buy with, all stocks are supposed to be our conviction stocks, but typically we look at it with margin of safety as a very big lens, which is where I said that if in our kind of markets we see stocks running ahead of fundamentals, we are happy trimming it. I mean, just to give you an example, right? In the India Ascent portfolio, we were early buyers of power generator sets, right? Who are core vendors to data centers. And at that time, that was not really the core, market wasn't really capturing that so well. But it rallied very sharply, and it rallied significantly. That's where we felt that, I mean, while the story is still live, but valuation does not give margin of safety. So we kind of made good money out of it and exited out of it. Similarly, at a time where energy storage was, happening, we bought into another name where we thought that this is a business that would evolve, over the next 3 to 5 years and become larger. There we've seen decent amount. We've been able to buy it early. So the whole focus on portfolios is not to buy, winners of the past, but basically try and build or focus on, companies, sectors that we think will be the larger growth providers and value unlocking spaces over the next 3 to 5 years. So that's the way, we've tried to choose on a bottom-up basis across both these portfolios. Both are distinct. There are, very few overlaps because the risk profiles are different.
Sure. And which are these winners in the recent past? I mean, give us some, if not on a stock specific basis, maybe at least on a sectoral.
Sure.
And also what has not worked also.
Yeah, that's true. So in terms of what has done well, in one of our portfolios, which is all cap, we were earlier investors for sectors in healthcare. So like instead of healthcare, we didn't go into the crowded hospital space. We went into diagnostics, and that's done very well for us. Secondly, even industrials is a wide space. So there we've not gone into, we've gone into players which are established leaders in, in basically engineering equipment, where we think that markets have been underappreciating their capability building over the last 2 years. And where more importantly, we've seen that the quality mix or the revenue mix of the company is changing for higher value add products, which could give them tailwind on margin recovery and earnings recovery, apart from the fact that export opportunities have opened up. So those have been kind of then the other unique area which is a good blend between industrial and auto comps is there is a lot of names which we own across our portfolios where we think that auto comps are diversifying from just being core supply vendors to auto OEMs, but they're also evolving as non-auto vendors as well. It could be bearings, it could be some other component businesses where they have the right to win from a technology standpoint, and which we think that it's at least a runway of another 3 to 5 years where we think that growth will continue to compound. So that's been some of them. One on the India ascent was an interesting one where we kind of focused on digital infrastructure, where again it was they are one of the larger players providing data capacity to data centers. So, I mean, those are kind of ideas which we try and incubate. It may not be early movers today, but they can definitely, we think, would evolve over the next 3 to 5 years.
While the approach is predominantly bottom up, which is what you mentioned, I'm sure you like some theme specific opportunities. You mentioned the energy storage. Is that also your most favorite theme at this point, or you have few
evolving though, but we tried to dip into one of the players there where we thought that it could have again the whole approach is not to be focusing only on one particular space, so that there are more diversified revenue streams, and more importantly there is a good brand and a moat that the company is built through. So that's the advantage. Our endeavor is to look at companies which are amongst the top 3 in the sector. That is where our endeavor is.
across market cap.
Across market caps, across sectors. So that, when the earnings momentum does come through for the sector, for the company, they are amongst the larger beneficiaries. That's the way we try and build it. I mean, like just to give you an example, electronic manufacturing. There again, that industry has gone through its cycles. There was a phase where there was too much of exuberance, it came off, but things are coming back. So that's these kind of spaces where we feel that, as I told you, we feel that if there may be near-term underperformance, we are not kind of shying away from that. But if it is a thesis erosion, then we kind of exit out.
Sure. Ashish, some tough questions for you. I'm going to put you on the spot. I'm not going to ask you where is the Sensex going to be at the end of the year. That's not the question, but when are the FIs going to return?
I wish I would have known, but I think to be and to keep it simple, I think if 2 things the market is willing to give the comfort is one, the fact that earnings recovery comes back, because to be fair, from 24, we've seen a big drawdown from a 24% kind of growth to 7-8% growth. So I think that recovery is paramount because India is looked at a growth market. Most global investors look at it as a growth market. And second is the currency volatility. So we've seen our spat of currency volatility in the last 3 months. And I think importantly so, government, RBI, both have recognized this with various kind of reforms and steps forward. So I think these are building blocks to bring them back. Having said that, we've seen that FIs kind of selling out over the last 2 years. At the peak, they were somewhere close to about, if you look at MSCI, they were about close to 20%. Now they've come down to 11%. I think the average anywhere is 18, but even if it goes to some form of mean reversion, you should see that. So I think that's the way I would put it. The good part is we are hopeful that the earnings recovery is coming back, which is a first thing. Post these reforms, we've seen rupee also recover. So I think there should be some consistency over maybe another couple of months, and hopefully that should help.
Yeah, I'm sure it's a tough one. One more tough one. You mentioned the currency volatility, but we've seen most of the overhang risks when it comes to the rupee is kind of behind us. The Strait of Hormuz is kind of opening up or opened up, but the rupee is not appreciating. We've seen a slew of measures from the RBI and the policymakers to support the rupee, but still the rupee is not recovered really. We've seen in the past many instances, 2008 and 2013 and all that, and many other instances which are related to oil. Rupee has recovered more than 10% or even 15% in one or two occasions from its lows. So that has not yet happened. So is a rupee recovery on the cards?
That's even tougher than calling a stock. But what I would say is that, I think, the whole US-Iran thing is still a lot fluid, right? You are seeing those things. Oil price is still a little fluid. I think these two are still, things which are evolving situation. And for that reason, I think it's not going to be a one-way recovery that you've seen in the past. But having said that, if I was to see it the other way around, the government is taking a lot of these initiatives to build, FTAs, bilateral trade agreements, and look at building blocks for exports. And I think those would be very, very, an interesting data point is that what I was just reading, is basically Indian currency for some of the businesses is now, after having seen this devaluation, is kind of competitive versus China, some of the particular sectors, right? So I'm not saying that that's the base case, but two things. One, oil, the US-Iran thing is fluid, so it will take its own time where market says kind of it gets mature of these things really getting visible, because right now we're still seeing a lot of back and forth. And second is as growth picks up, you will see flows in terms of flows come back. Second, I would think these FTAs would bring more than FPI, FDI, right? And for that as well, they would look at some currency stability. So my personal sense is that we should look at a better, period from October onwards. Even the other niggling worry, or rather something that is an overhang on markets, is the extent of monsoon, pickup. It's been a happy
2 days we have extremely good rains and at least
yeah.
where we sit in Mumbai. Yeah. Okay, so one or two final points. You mentioned the FTAs. Are there any particular sectors that will be a beneficiary from these deals?
So there are a host of sectors. I would think that, prima facie, it's more of markets than sectors. So I think European market and the US, these are two big markets. I think the one which has been signed by EU is extremely beneficial for pharma, healthcare, autocoms, chemicals, textiles, engineering equipment, because that brings India, while India has a lot of competitive advantages, it brings them from a pricing standpoint a lot more competitive. So I think that's a big factor. US, again, we were kind of very select sectors, but as this firms up and we probably get a good agreement in place, that can open up host in our conversations with a lot of companies, managements across sectors. They are doing a lot of spade work for being able to be ready for this over the next 2 years. It's not going to happen in the next 3-4 months, but I think over the next 2 years is where you see an additional bump up come from these sectors.
Sure. Behaviorally, when it comes to investors, individual investors, people do follow trends, and they do get influenced by these trends when it comes to their investing also. We have seen a lot of examples on the mutual fund side, like the rush for maybe the silver funds, or when they chase sectoral funds at some point in time, or various other trends we have seen. On the PMS side, do you see any behavioral trade among investors? These are mostly well-to-do investors or the HNIs that predominantly invest in, or the evolved investors that come to PMS. Do you see any behavioral trait or anything that comes to investing?
I think interestingly, frankly, if I was to see, we've seen a lot more maturity amongst investors now, and that just from a data point standpoint, the kind of outflows from foreign investors that we've seen has all been absorbed by markets here from retail investors, right? And I think that's a very important and a mature sign of the way retail investors have evolved. And I think even in times of this adversity of US-Iran, the kind of challenges we had of oil price and all of that, we still saw the longer term approach of investors coming through. And I think that is what is changed. So the entire fabric of having to look at momentum investing is slowly moving towards a lot more mature set of investors, which is a good thing.
Awareness is definitely.
Awareness is definitely.
Ashish, it's been a pleasure talking to you. Thanks a lot for joining today. And we also want to thank the audience today who have joined us. So we'll conclude the session with that. Thank you very much.
Thank you very much.